Demand for coal is increasing in the U.S. again, brought on in part by the rising cost of natural gas. The EIA estimates coal consumption and electricity generation will increase nearly 20% this year. But a new report out from S&P Global Market Intelligence says an aggressive push to mandate renewable resources could strand roughly $68 billion in coal assets. Let's bring in Steve Piper, the author behind that report. He is S&P Global Market Intelligence Energy Research Director. Steve, it's great to talk to you today. Let's talk about what we're seeing right now, because I looked at that government data. It is a little surprising when you think, well, I thought we were talking about moving away from coal. That number is moving up again. What's behind that push? And is there a concern that coming out of the pandemic, as we see the economy rebound, there is a reliance on coal yet again?
Yes, thank you for having me on today. Certainly, coal is doing a little bit better this year compared to 2020, which was a historically bad year. The interesting thing is, as you indicated, the price of natural gas is much higher as a competitive fuel to coal generation. So we're seeing coal recover this year. And what it really tells us is that the reduction in carbon emissions that we've enjoyed over the last several years due to natural gas being more competitive than coal generation, that era may be coming to an end. And that if we expect to see additional emissions reductions from the coal sector, renewable energy is going to need to continue its rapid expansion.
Now, as I understand it, to retrofit one of these coal plants, and I think your report covers about 100 of them, that they generate 130 gigawatts. What happens if these plants are in fact stranded? Are we going to see rolling blackouts? I mean, are these located in parts of the country where the electricity is critical to the grid?
Absolutely. The coal fleet, will remain critical. The prospect of the coal plants becoming uneconomic is a matter of concern. If they become stranded assets, that generally means that to the extent they shut down, they're going to be replaced by renewables generation and new technologies that probably will maintain to a certain degree reliability on the grid. But the question of what happens to all of those investments in pollution control over the last 5 or 6 years becomes critical, because those investments were undertaken with the expectation that they'd be able to recover those costs.
So what happens if you can't recover the costs?
Well, the investment community starts to back out of those assets. They may shut down. And then, rates would have to increase to essentially replace those assets. So it becomes a financial question of how do you sort of recover the costs of pollution control investments over a shorter period than was originally, contemplated when those pollution investments were made.
I want to ask you, has this played out in other countries, other regions of the world, someplace where we could kind of look to that as a model and say, okay, this seemed to go pretty well over here, or are we simply all progressing at this on the same timeline here?
The experience in the United States is somewhat unique in that the United States has done more than probably other regions of the world to deregulate power markets. And in many parts of the country, expose those investments to competition from newer forms of generation. So, the question of stranded investment and stranded cost is fairly unique to this country.
And Steve, we've seen the challenge that comes with this transition, not necessarily in coal, but with oil, for example. If you think about the investments that are being made in renewables, if it's about transportation and EVs down the line, those are investments that we see pay off years from now. And yet in the meantime, you've got the White House, which has made climate the center of their domestic platform last week, calling for an increase in production from OPEC because gas prices have gone up. When you think about having to transition from what we have seen, the demand on fossil fuels, to a more low carbon future, can you talk about the challenge, especially with coal, sort of in the middle here? What does that transition period look like? How bumpy is it? And ultimately, what kind of hit do consumers have to take because of that?
No, it's a great question. It's an issue of concern to policymakers and to the American public. Certainly, the need to decarbonize the electricity system, is being increasingly recognized, and that involves basically replacing our old generation systems, coal and increasingly natural gas, with new clean generation, backed up by storage technologies and other new technologies. Replacing new things with old things costs money, and what our report draws attention to is that making those investors whole on the original investments also costs a bit of money too.
Steve Piper, S&P Global Market Intelligence Energy Research Director. It's great to have you on today. Really appreciate the time.